Meta just committed what looks like the ultimate financial sin. They walked into their Q4 earnings call and announced they are effectively going to light $135 billion on fire in 2026. To put that number in perspective, that single spending figure is larger than the entire market cap of companies like Starbucks or Nike. The last time Mark Zuckerberg announced a spending spree of this magnitude, Wall Street panicked. The stock collapsed 25% almost overnight. But this time, the rules have changed. The stock didn't crash, it ripped higher, surging over 4% in the aftermarket. Why? Because hidden deep inside this report is a secret ROI metric that the headlines missed. It proves that this money isn't being wasted. It is being invested into a machine that is already printing cash at a scale we have never seen before. Today, I'm breaking down exactly what that secret metric is. And at the end, I'm giving you the 3 exact price levels the institutions are defending, so you know exactly where to buy. Let's dive in. First, let's look at the scoreboard. This was a textbook double beat. Top-line revenue smashed expectations, coming in at $59.9 billion. That represents staggering 24% year-over-year growth. For a company of this massive size to still be growing at 24% is almost mathematically impossible. On the bottom line, profits were even better. Earnings per share hit $8.88, completely crushing the analyst consensus of $8.19. But the real story is in the ad metrics. For years, the bears screamed that TikTok would kill Instagram. The data proves that narrative is dead. Look at this. Ad impressions are up 18%, and the average price per ad is up 6%. This is the holy grail for any ad business. It means more people are watching more reels, and advertisers are fighting harder to pay for that attention. The platform isn't shrinking, it's densifying. But what really forced the short sellers to cover was the guidance. The stock market is a forward-looking machine, and Meta just hit the gas. They projected Q1 2026 revenue could hit $56.5 billion. That implies revenue growth could accelerate to nearly 29%. When a trillion-dollar giant accelerates to 30% growth, you don't sell, you buy. Now put the champagne away. We have to address the elephant in the room. The number that terrified the market initially, capital expenditures. Meta confirmed that in 2026, their Capex will balloon to between $115 billion and $135 billion. The street was only expecting about $110 billion. Normally, a spending hike this big is a sell signal. It eats into free cash flow and lowers margins. It signals that management is reckless. So why didn't the stock tank this time? Because Zuckerberg proved this isn't charity. It's an investment with an immediate return. Management revealed a bombshell statistic. Their AI generative video tools for advertisers have already hit a $10 billion annual revenue run rate. Think about that, $10 billion. That is larger than the total revenue of many Fortune 500 companies, created essentially out of thin air by their AI stack in just a year. And it gets better. Internally, their Meta Llama coding assistants are writing code for them. They reported an 80% efficiency boost for their software engineers. This validates Zuckerberg's new vision of personal superintelligence. He isn't burning cash on a VR dream anymore. He is building the most efficient money printing machine in history. So let's talk price. Is Meta too expensive to buy at $670? If you look at the standard PE ratio of 30, it might seem rich. But that is a rookie mistake. You don't buy stocks for what they did last year. You buy them for what they will do next year. On a forward PE basis, Meta is trading at just 18 times earnings. Let that sink in. You can buy a tech monopoly growing at 30% for a cheaper multiple than Coca-Cola or Costco. That is a dislocation in the market. In financial terms, this is called growth at a reasonable price. The growth rate is higher than the PE multiple, which is the definition of a deep value play. Even if we assume a conservative slowdown, buying at these levels offers a mathematical probability of double-digit returns over the next decade. It is a super growth stock disguised as a boring value stock. Okay, put away the calculator. Let's look at the chart. If you want to trade this, you need to know where the institutional algorithms are sitting. I am watching 3 specific levels. You might want to write these down. Level 1, the buy zone at 665.6. This is the point of control. It represents the price where the most volume has changed hands recently. It acts like a magnet. If the post-earnings hype cools off and the stock dips, 665.6 is where the institutions will likely step in to defend their positions. That is your safest entry. Level 2, The breakout at 724. This is the ceiling. There's a wall of sellers here. But if we break above 724s and close there, the sky is clear. Above 724s, there is almost no volume resistance. That is the launch pad for a run to $760 and beyond. Level 3, the danger zone is at $600. We have to protect our downside because if we drop below that level, we're in trouble. Our final line of defense is $580. If that breaks, don't overthink it, cut your losses immediately and sit tight for the next buying opportunity. The headlines will tell you Mark Zuckerberg is spending too much money, but the bank account proves that his AI bet is already paying off. This $135 billion expenditure isn't waste. It is a moat. A moat so wide and so expensive that no startup and no competitor can ever hope to cross it. But Meta isn't the only player. I'm currently watching 3 other stocks that are quietly building the infrastructure for this AI boom, and nobody is talking about them yet. If you want to know what these 3 stocks are, smash that like button and subscribe. If this video hits 50 likes, I'll do a deep dive and reveal all 3 in my next video. My research is completely free, so a quick like is a small price to pay, right? Thanks for watching. See you in the next one.